Hey, what's up? I'm Russ. Thanks for popping on by the channel. I thought this would be a good time to go ahead and do a dividend portfolio review for all y'all so you can get a little flavor of what a seasoned dividend investor has in their portfolio. Now, this is not my entire net worth or anything like that. These are just stocks that I specifically own outright. And two of them, though, are in retirement accounts. You can head to DapperDividends.com, click on My Portfolio, and there you will see the three portfolios. So we have the Bridge portfolio, which is what I am building for my wife and I, that we will have extra income in the near future for bills, food, entertainment, whatever, if we so desire. The second portfolio is the self-directed IRA, and this is really interesting. In March of 2020, I pulled $30,000 from my retirement account, my 401k, through my work. I basically did a rollover into a qualified account, and the only thing I had to pay, it was at American Funds at the time, was about $125 in transfer fees, I believe is what it was. And those are now in a self-directed IRA, meaning they're not mutual funds. I can pick whatever stocks I want. I can go crazy with penny stocks if I wanted. I can sell covered calls, which I do some of that. And then the third one is the Roth IRA. Now the Roth is all after tax income. This is all money that you've already paid taxes on and you've gotten into your bank account. But the beauty of this is you will never pay taxes on that again, provided that you don't take the gains out until you're at least 59 and a half. I believe right now it's $6,000 a year that you are able to put into the Roth. And the beautiful part about that, and the thing a lot of people don't know, is that you can always take out your contributions tax-free. So if, to make it simple, if you put in $6,000 and you have a $6,200 gain, you can pull out $6,000 and you'll be just fine. As always, though, I'm not a financial advisor, so take this YouTuber's stuff he says with a grain of salt. Before we begin, I wanted to say that the important thing that I love about dividend investing is that it's allowing me to do something that I was never taught about growing up. I feel that as I grew up, I was taught to sell my time to other people, to let other people dictate my time, and I would have to do that until I was about 65. But there's a better way. There's a different choice. You can start doing one of many things, and this is probably the most simple, not easy, but simple way, is to just buy companies that pay dividends and hold them, collect the dividends, reinvest them, and never sell. When you do that, you're earning passive income. Now other people are paying you money and you're buying some of your time back. Again, this does take a little while to get that snowball rolling, but it is very, very important if you ever want to be financially free, which, as I always say, is to do what I want, when I want, with whom I want, on my own terms. And that, I think, is something that everyone should be aiming to do. So here we are in my portfolio. Now remember, this is a mix of, in actuality, 4 different portfolios. And remember, 2 of them are retirement accounts and 2 of them are taxable accounts. So the annual income on this $116,000 is $4,379. Current dividend yield of 3.77%, but my yield on cost is 4.44%, which is really beating the pants off the market. And again, know why you're investing. For us with these stocks, I want a high dividend yield that's sustainable and has the chance to keep growing without too much worry about it being cut. So almost 4.5% yield on cost and a beta of only 0.52. If you don't know, beta is a measure of market volatility. To put it simply, if the market goes up $1, this portfolio will only go up about 52 cents But if the market were to drop $1, this would only drop about 52 cents because many of these stocks are defensive in nature. So they're not going to grow a lot, but we're sacrificing and trading off that growth for dividend income, for cash income, which is so solid. It's real, it's tangible. We got that cash, and that can't be manipulated away by accountants. Touching on the diversification, the bulk of it you can see is in consumer staples. Now, they recommend that you don't have more than 25% in any one sector. We are at 28% there. And very interestingly, we have only 1% in materials, which is LyondellBasell. This is a company that I love. They do polymers, olefins, things that go into plastics. If I look at this, I really feel I would need to bulk up on materials, utilities, information technology, and probably financial. And if we look at the income, check it out. This is the top ones. They think that you don't have any individual stock contribute more than 5% to your total income. Probably a good rule of thumb. So I've broken that rule on a few here with AT&T, which, as you know, it is going to be cut. There's a video right here we did on AT&T, and I like to call it a right sizing, not so much a cut. But Pepsi, 9.7%. You know, I've been buying a share a week for 100 weeks. We're almost there. We'll get to that. Realty income, I bumped that up to 100 to sell covered calls, as well as with Omega Healthcare. By the way, the Simply Safe dividends really slick. Looking at the week ahead, I got $6.75 coming from Unilever, $28 on Friday coming from my Lockheed Martin, and some other nice dividends coming in the weeks ahead. Now, the income forecast, were I to do nothing more to this and kind of just let it coast, they are saying that it should grow, if we look at the average of the annual growth, to about $11,400 annually by 2042, which shows the power of dividends by not doing anything else, because a lot of these companies are constantly increasing their dividend. Now, as we get into the portfolio, if at any point you might want to pause the video and take a deeper look at some of these numbers, I'm going to try and go through it a little bit quickly. I'm not going to spend a lot of time on 51 holdings. We'd be here all day. But again, these are shared over on DapperDividends.com. You can click on my portfolio and check them out there. I used a grin. You can't view them in Simply Safe Dividends, so this is your only shot to check them out here. And why don't we start by sorting these? By the way, really nice with Simply Safe Dividends, you can put all different kinds of sorting criteria and columns into this, but we're going to sort by percent of portfolio and go from there. So first we have Pepsi with 92 shares. I just did buy that 92nd share. And one thing I want you to look at is the yield on cost. This is really important to me as a dividend investor, is that when you buy a dividend and they keep increasing it, remember, you're locking in that yield on cost. So a lot of these are going to have yield on cost that's a lot higher than the current dividend yield, which is part of the magic of dividend investing. And we do see Pepsi has a 3.10% yield on cost versus the current 2.83%. And we're getting $423 of annual income from PepsiCo. And if we slide over, we can see ex-dividend dates, 5-year growth. I have some numbers in here, how long they've grown it. So if you wanted to sort by the ex-dividend date, and the very next one that is indeed coming up is 4 days away. There's two of them, British American Tobacco and Altria. But getting back to the percentage of the portfolio, so 12.9%, that's a little bit high, but I feel, as does Simply Safe Dividends, which gives Pepsi a very safe dividend safety score. I think they're a core position, and I really wanted to build them and get to 100 so I could start selling covered calls, mostly way out of the money for just a few extra bucks every month, every 4 or 5 weeks, maybe looking at an extra 20, 30, 40 bucks from those shares of PepsiCo in addition to their dividends. AT&T is next with 7.5%. Now this one we're down 27.3% on, and they are going to be cutting the dividend, or as I call it, right sizing, because they're spinning off Warner Media, and that's going to leave them with a bit of a hole of revenue coming in. So they're taking in less money, so they're matching it to that. But I'm still bullish on AT&T. Johnson & Johnson next, 6.5%. We have 18.6% gain on Johnson & Johnson on 43 total shares. We also have Realty Income. Oh, by the way, Johnson & Johnson, a dividend safety score of 99. So that's very, very cool. Very solid company. Realty Income, the monthly dividend company. We have 100 shares of that because we sell covered calls on Realty Income, up 9.7%. And one trick that I like to use that I'll mention here also is if I'm looking for an idea for something to buy, I will see if the current dividend yield is above my yield on cost, like it is here with Kimberly-Clark. Current dividend yield is 3.84%, and my yield on cost is 3.37. So just by buying Kimberly-Clark, I can increase my yield on cost. AbbVie has been running up crazy. Check it out. We're up 77% on AbbVie, 36 total shares. And look at this yield on cost. Look at that, 6.29% versus current 3.54% dividend yield. And the longer that you're in this, the bigger those gaps can get. And someday that probably is going to be over 10% because they keep increasing that dividend. Now, we talked about Kimberly-Clark. They do paper products. They do a lot of the diapers and Kleenex and things like that we use every day. So definitely a defensive company. But they're good for $194 of annual income. Next, percent of the portfolio. Now, these are all good in line. Like, this is kind of where you'd want to be, 3, 4, 5% of your portfolio. 10 shares of Lockheed Martin, 3.32% yield. We're up 26.4%. They've had a bit of a run up, as you will see with most of the defense contractor stocks. 3M, I like 3M. We are down 15%. They're going to have some legal troubles in the near future, but they still have a 75 safe rating of a dividend score from Simply Safe Dividends. And when you see this, what I like here, they may be undervalued. Their dividend yield is currently 32% above their 5-year average. So this is really nice that Simply Safe Dividends does that. ExxonMobil, check out this. Yield on cost, 7.79%. We're up 74.2% on ExxonMobil on those 44 shares. And remember, this is an amalgamation, a combining of all the portfolios. McDonald's, only 14 shares. But again, that dividend yield is over 3%, when if you were to buy it right now, you would only be getting 2.31% of a dividend yield. $77, but not bad, nothing to sneeze at. Next is Duke Energy, ticker DUK, one of my favorite utilities, regulated utility companies. We like the regulated utility companies because they have a stream of basically guaranteed customers that the government is saying they're not going to go anywhere. They're going to be your customers. 20% were up on those. 4.52% yield on cost. Very nice. Now, Omega Healthcare, this one is a little risky. I would not be surprised if it was cut, but I'm going to stick with it. And this is one of the reasons why I'm sticking with it. It's only 2.7% of the portfolio, but percent of income, 6.5%. So that would be a little bit of a hit. And we're going to see what happens with them. But this is why some of these sites like this are fantastic, because they're giving you a heads up. And while I am down 21%, chances are if they cut that dividend substantially, then a lot of investors are going to just start leaving and that share price is going to come down. But this is a risk I'm willing to take. And I think over many, many years, it will recover and they will start increasing that dividend once again. Chevron, we have 15 shares. We're up 90% on Chevron. That is crazy. 6.69% yield on cost. Prudential, one of the financials, great idea for Prudential and the like. When you see a sector that's down, Prudential and MetLife are two that I was buying when the banking sector was pulling the entire financial sector down. So you can look in beaten down sectors for ideas. And Prudential, not a bank, but they are in the financial sector, which was down. So I was really buying heavy, and you can see I'm up 57%, $73.32 yield on average cost per share, but the yield on cost 6.55%, and they're good for $100 a year of income. Cisco Systems, this is a company that's again in like computer routers and things like that, up 24%. Another defense company, way up, General Dynamics, ticker GD, up 61%. $50 a year they're bringing in. Look at that dividend safety score, 97. 99 is the highest you can get, so very comfortable. And current 3.53% yield on cost. Love to see that. Starbucks, company I've been looking at buying, and I was going to buy more at like 79 a share, and I waited. I wanted to see if we could get a greedy, a little bit cheaper, and it started taking off. It's almost $90 a share right now, but we're up 20%. Altria next. If you follow the channel, you know that I had my shares called away from a call option that was assigned, but we have the cash, and I'm selling cash secured puts, trying to get in around $50 a share. Those were called away at 52, so I'm ahead of the game still, and the few shares I do have left, we have an almost 8% yield on cost, and it's still bringing in $151. Clorox, we were buying Clorox, ticker CLX, and we were buying that in the 160s, 180s. So happy to keep adding here. They do believe that dividend is safe, but look at the payout ratio, 103%. It's going to be high for just a little while. So could be a little bit risky, but I think they have a great company and they will be just fine. Verizon, 1.7% of the portfolio, 39 shares of Verizon. We're down 8.2%, but very safe dividend score. So this looks like a good time to keep adding Verizon, as their dividend yield is about 13% above their 5-year average. And check that out. If, depending on when you're watching this, 18 days away is their ex-dividend date, meaning that you can't buy on April 7th. That's when it's ex-dividend. You have to buy the day before. So you would have to buy April 6th in order to get that dividend. Procter & Gamble, products all around your house from Procter & Gamble. Just look in your bathroom. I bet you'll find 2 or 3 Procter & Gamble products on the packaging. 2.92% yield on cost, 99 safety score, and another 99 safety score is Honeywell, ticker HON. We have 9 shares. We're up 30% on those shares, and a yield on cost of 2.62%. Now, this one I love. This is my industry, Eaton, ticker ETN. They do a lot of electrical components. They used to have a fluid power division that they sold off, which I work with hydraulics and electricity. So I know them. I see them all around, which is why I was buying them at $83 a share, which I'm up 86%. But look at the magic of this again. The current dividend yield is 2.8%. Our yield on cost pushing 4% at 3.88%. And this is why it's just, again, so great to buy and hold. And you can even turbocharge that if you're able to buy these stocks when they're at a discount. Moving along, Archer Daniels Midland, ticker ADM. We're up 101%. They do food. They are there, and they are bringing food to everybody. So without Archer Daniels Midland, we don't really eat. So they are very necessary. And again, less than 2% current dividend yield. We're at 3.84%. Again, highlighting why it helps, and it's great to buy early and hold. Moving it along, we got JP Morgan. We're up 28%, 10 shares. 3.66% yield on cost. I just love looking at the yield on cost. They say that they may be undervalued because their dividend yield is 9% above the 5-year average, and they only give them a 60 borderline safe dividend score. Very interesting. Simon Property Group, they own malls, a lot of like upscale malls. We love Simon Property Group. Obviously, we hold them up 46%. 7.37% yield on cost. But look, if you buy in now, you can still get it at a 5% yield on cost. And they have a pretty low payout ratio for mall REITs. IIPR, they are regulated cannabis. They own the warehouses and the big buildings that the cannabis growers use. So more along the lines of they're not growing it themselves, but they're kind of the company that's selling the picks and shovels to the gold miners instead of going out and looking for the gold themselves. 3.98% yield on cost. Like this company, and I'm looking for them to come down a little bit closer to our average of 175 to add a little bit more. LyondellBasell, we touched on them in the beginning. 40.2% we're up. 6.19% yield on cost, but you can still get it at 4.41. 51 borderline score, and they have a 26% payout ratio. They are a chemical producer. They make a lot of the, again, polyphins and olefins that go into plastics, and they are tied into the petrochemicals. Leggett and Platt. Leggett and Platt makes a lot of bed frames, hardwares, mattresses, car seat cushions. They are very diverse and a company that not a lot of people have heard of. And currently, now this is one idea for me. Look at this. My yield on cost is lower than the current dividend yield. So I could actually get a higher dividend yield and bump that up by buying where they are at right now. And that dividend yield, see, they may be undervalued. Current dividend yield is 28% above the 5-year average. Merck, 99, very safe. That is very interesting to see because they are a healthcare pharmaceutical company, and their current dividend yield is a little bit below ours of 3.67%, and we're up 5.1%, so this could be a good buying opportunity as well for Merck. Again, MetLife, along the same lines, they have Snoopy as their logo, so along the same lines as Prudential, they're an insurance company. And look at that again, what buying and holding does. I can't say it enough. Our yield on cost is 4.58%, but currently it's at 2.8%. Wonderful to buy and hold. Plus, we have the 63% capital appreciation as well. Intel, done a few videos on Intel. I just started a position, but you can see we are really starting to ramp it up. And I would like to be more into the technology, the semiconductor space, because this is the future, right? And again, 2.94% our yield on cost. We can bump that up by buying where it's at. Gilead, ticker GILD. Pharmaceuticals in that healthcare space, 70, they have a safe score, and they have a dividend yield that is currently 30% above the 5-year average. So they may be a good buying opportunity for just a little bit more of us as well. And we can bump up that yield on cost with Gilead. Genuine Parts, car company, car manufacturer, up 36% on them. We were buying them heavy when they were down during the pandemic sell-off. And you can tell our dividend yield on cost is 3.79% versus 2.78%. Moving along, Unilever, ticker UL, we're down 14% on. This one, yeah, it dropped. We added some more, and I probably will look to add some more. Why? Because their dividend yield is 40% above their 5-year average, and we can substantially pump up our yield on cost from 3.75. It's at 4.38 currently, so that's another one that we're likely going to be adding to. Microsoft started a position way back coming out of the sell-off. You can see $202.97 was the cost per share. We're up 48%. Yield on cost, not a lot, but it's 1.22 versus 0.83. This, I don't know what I'm going to do with, but I'd like it to come down somewhere to the low 200s and potentially add a little more. Kellogg's, only 8 shares. Obviously, you know Kellogg's, they feed everybody. We're down 6.3% on Kellogg's though, so that's another one. We could increase our yield on cost. Ahold Delhaize, Koninklijke Ahold Delhaize. They are from the Netherlands, I believe, and they are a grocery store. I think they own Food Lion here in the United States, which they have a little exposure. 11.2% we're up. And Stag is up next. Ticker STAG, Stag Industrial. They also pay dividends monthly. They are a REIT. By the way, if you hold REITs inside of a Roth IRA, that's very, very good because you're not going to pay any taxes on the dividend income. Something to keep in mind with REITs because they're a pass-through entity and their dividends are non-qualified. Albertsons, the only reason I bought Albertsons was because here in the Chicagoland area, we have Jewel Osco, which was acquired some time ago by Albertsons, but boom, look at that. Up 132%. Yeah, I wish I would have bought more. Our average is $15.16. 3.17% yield on cost, which only if you bought now is 1.36. Only bringing in $4 a year. But hey, we'll take it. And they have a very low payout ratio. So I don't think I would buy them anywhere near here. Energy Transfer, This is a limited partner, another pass-through entity, so we hold them in the Roth, up 58%. Look at the yield on cost, 11.31% for our yield on cost, and the current is 7.15% right now, which is not very bad, and they get a 50 borderline safe score. Campbell's Soup, ticker CPB. This is one that my guy Ryan Williams sold, and I think we're going to keep holding it, maybe bump that up to 10 eventually, but we should buy more because we can, again, bump up our yield on cost, so it's above our yield, so it would make sense to add more. Safe score, not sexy company. They're not going to be going anywhere crazy to the moon. Store Capital, they're another REIT. We recently started buying them, which we're down 3% on, but they do have a dividend safety score of 70. British American Tobacco, I may pick up a few more shares here because the dividend yield is over 7% still, but they only do get a borderline 45 safe dividend score. They have a low payout ratio for the sector. Remember, sin stocks, the tobacco companies, they have a higher payout ratio usually, but I would have to buy by March 24th to be able to qualify for the next dividend. MGM Growth Properties, very interesting here. I bought these when we were in Vegas. We were at the New York when I bought these shares, and I said to my kids, we now own. We're the landlords of this property. And if you didn't know, MGM Properties was broken off from MGM, and they basically became the landlords. So MGM, the gaming company, is a tenant to MGM Growth Properties, who owns the building. They own the land in Vegas and other parts of the country and the world. So very interesting setup. They are a REIT, and we only have those 5 shares, but we're up 21.2%. And this is why I don't want to sell. We have a 6.87% yield on cost, which is very solid. Getting close to it. Enterprise Products, ticker EPD. We want at least 10. We just started buying this recently, and we're already up 0.9%. They have a safety score of 65, which is great for a company that's over 7.5% current yield. I think we will be buying more EPD because of this. Their dividend yield is 15% above their 5-year average. And they have been growing that dividend for 23 years. You know, I talked about uranium. I think it's the green energy of the future. We love uranium. I lived on top of some microreactors on board the USS John C. Stennis. I'm okay. Don't have a third arm yet. And they are giving me exposure to 35 companies that mine uranium. They hold uranium. There's various different things. And the big reason is I wanted exposure to Kazatomprom, which is the world's largest, I believe still, miner of uranium. So they are a Kazaki company, but I could only buy them on the London Exchange. So much easier to just buy the ETF and get my exposure that way. SCHD, the Schwab High Dividend ETF. I will be doing a video on this in the future, so you're going to have to wait a little bit. And yes, it is an ETF. I have a very specific reason why I have SCHD and DIVO, which DIVO is a covered call dividend ETF. They try to buy very high quality dividend paying companies, and they sell covered calls on those for additional income. So stay tuned for those 2 stocks to be covered in an upcoming video. And then Volkswagen, they just increased their dividend 51%. They pay out once a year. So if you wanted to get Volkswagen's dividend, you're going to have to buy by May 13th. So May 12th or earlier if you want to get their next dividend. And again, they did increase that 51% just recently. And one more thing about Volkswagen, I think that they are going to be a major player in the EV market. They own companies like Porsche and a lot of other brands. They have a very diverse lineup. So I think this is a great company to buy and hold for the long term. And then the redheaded stepchild, ONL, Orion Office REIT, ticker ONL, they were spun off from Realty Income. I think office buildings are dying and going away. I'm down 16% on that. The spin-off price that I got it at was $20.63. I may just hold it, see the dividends they're going to pay off. I'm not going to add any more, but when they go green, I probably will just sell those anyways. And remember I said we got about $5,200 from the sale of Altria. Well, I'm selling cash secured puts, which means I have to hold $5,000 for that $50 strike. So there will be $5,000 in the account. I just look at it like it's not even there. The baseline is $5,000. So that is earmarked toward Altria. I will eventually get back into that. I really would love to know what you think about this. What companies are you surprised I hold? What ones do you hold? Who are you looking at? Any suggestions? Share your comments down below because you know where the comments go. And by the way, if you'd like to know about dividends, buybacks, and stock splits, we did a video about them. I'm not threatening you. In the little box next to my head right here. I hope you click it and I will talk to you there.